I'm Dr. Sonali Dharmadhikari. In last session, we have seen the first step of accounting, that is financial accounting, that is recording. And the book we have seen is journal. Now today we will start with the accounting cycle. So what is accounting cycle? Which completes in financial accounting. Accounting cycle, it goes on and on every day, and at the end of year it gets completed. So first step is recording the business transaction, and for the purpose of recording we have seen the book called journal. Then after journal we classify the account. Classifying the book is called ledger. Then after that, summarizing, which is the book or the balance, is called trial balance. And the last step is analyzing. Final accounts are prepared in analyzing. These are the main functions of accounting which are covered in these parts of cycle. So now we are going to the second step. After the business transactions are recorded in journal, next step they are classified into ledger. So what do you mean by a ledger? In ledger, each and every account is opened. That is personal account, real account and nominal account. Each and every account is opened separately. Why? What is the need of ledger? Suppose you want to know balance in the Amit's account. Amit is your customer. Amit is the customer of business. Now if you do not prepare his account, you will not able to classify the entries related to Amit. So in journal you will find day to day wise all the entries, but it will become difficult to tell Amit what is the balance he is required to pay. So to overcome this particular difficulty, ledger account is prepared of each and every person, each and every asset, liability, expense, income, etc. So that is called ledger. The next step is trial balance. Now when the ledger accounts are prepared, every business decides a certain period. It can be monthly, it can be bi-monthly, it can be after 3 months. So after that particular period, a review is taken of all the balances of ledger accounts, and a trial balance is prepared to summarize ledger accounts. And then at the end, the trial balance is taken and the final accounts are prepared, that is analyzing what has happened in the business. So final accounts consists of trading account, profit and loss account and balance sheet. Now we are going to see one by one how these accounts are prepared. Now first we will see the book called ledger. Now what are the functions or what is the objective of ledger? So ledger gets clear idea of what has happened in a particular account for a specific period of time. It can be of a debtors account, creditors account, it can be any expense account, what are office expenses, what are purchases made. So all these idea you can take it from ledger account. Then the balance is taken in each account. So at a particular point of time, you can say what cash, how much cash is available. So cash account will show you the balance. So that is called ledger account. Now there are various steps to find out the balance of ledger account. Now first you have to check which side is more, debit or credit. So we will see this by one example. This is the format of ledger account. In journal, there were no different sides, debit or credit. There were columns, debit column and credit column. Ledger account is segregated in two sides. Left hand side is debit side and right hand side is credit side. What are the columns? Date, particulars, journal folio. What do you mean by journal folio? There is cross reference of journal and ledger. The journal entry is posted to ledger. So the ledger folio number is written in journal and the journal folio number is written in ledger. So it becomes very easy to locate if there is any error, or you can cross verify. So journal folio and amount rupees. Same columns are on credit side, date, particulars, journal folio and amount rupees. Now how to post journal entry to ledger account. So we will take for example a journal entry. Cash account debit to commission account. Suppose rupees 25,000. How to post this journal entry to ledger account? Cash account is debited. So write on debit side of cash account. So suppose this is a cash account. Cash account is debited. Date is January 8. To commission account. Amount is 25,000. Now as we have seen in the principles of bookkeeping, one account is debited, by the same amount other account is credited. So on the credit side of commission account, you have to write by cash account 25,000. Date is January 8. This is your commission account. Never forget to write debit and credit in case you are opening ledger accounts. So this is the way journal entries are posted to ledger account in the second step of the accounting cycle. Now, how to balance the account? Because at the end of certain period, you are required to find out what is the balance in a particular account. For example, how much cash is available, or if a person is there, how much he is liable to pay, liable to receive, etc. So what are the steps? First, check which side is more. Now here we have taken only one entry. So if you take cash account, which side is more? Debit. So take total of debit side. Next step, repeat it on other side. As there are no other entries, find out the difference. So difference is 25,000. So if you are doing it at the end of January 31st, by balance carried down. At the end of the period, it is called balance carried down. Where it is carried down? To next month. So it is called carried down to the month of February. So carried down 25,000. February 1, you will write to balance brought down. Brought down means brought down from earlier month. So these are the terms used in balancing ledger account, and the ledger accounts are balanced. And now we will find cash account is having debit balance of 25,000 because debit side is more than credit side. So this is how the ledger accounts are balanced. Next step, as we have seen in the accounting cycle, is trial balance. So trial balance is the summary of balances of ledger account at the end of a certain period. Now we will see format of trial balance. Trial balance is always prepared on a particular date. Suppose as on 31st March. Again, you are always segregating the balances, debit and credit. Particulars, debit balance amount rupees, credit balance amount rupees. So once you will balance all the ledger accounts, one by one you will take it to trial balance. So we have taken example of cash account. So you will take here cash account is having debit balance of 25,000. We have seen the example. Commission account is income. It is having credit balance of 25,000. So if you take it to trial balance, commission account credit balance 25,000. Now here we have taken only one entry and one, but in practice you have to take all accounts, you have to pass all journal entries, take it to ledger accounts and prepare trial balance on the end, at the end of the year, that is 31st March. Now one important rule is trial balance has to be tallied. It means debit balance is equal to credit balance. So you will take here 25,000, 25,000. Every trial balance has to be tallied. If it is not tallied, it means there is error. You have to find out the error which will be there in trial balance. As we are following the principles of double entry bookkeeping, each account has means every one account is debited and other account is credited by the same amount. So there is always equality. Debit is equal to credit. So your trial balance must tally. Last and important step is preparation of final accounts. So what do you mean by final accounts? They are prepared at the end of the year to take the overview how the business has performed. So in India we follow the financial year 1st April to 31st March. So what has happened in the year, that you will come to know through final account, which is prepared at the end of every year. So first you prepare trading account, profit and loss account and balance sheet. Now we will see these accounts one by one. First we will see trading account. Now one important feature of trading account. This trading account is prepared for the whole year. So it is summarizing plus analyzing. So trading account you will find always heading trading account for the year ended. What do you mean by for the year ended? For the year ended means all expenses are taken from 1st April to 31st March. All expenses, all income, purchases, sales, etc. all are taken for the whole year. What is the objective of trading account? To find out gross profit. Gross profit means the profit after incurring manufacturing expenses. So to understand in detail or to analyze the figures, the expenses are segregated in manufacturing expenses, administrative, selling, distribution. So all manufacturing expenses. What do you mean by manufacturing expenses? That is purchasing the raw material, converting the raw material into finished goods and selling the finished goods. So these are the stages of expenses. Now first stage, that is purchasing the raw material and making the finished goods. Till that period or till that stage, whatever expenses are incurred, they are called manufacturing expenses. And sales minus manufacturing expenses is called gross profit. So why to segregate these expenses? Because you want to analyze what is the figure or what is the profit you earn only after manufacturing expenses, then after administrative expenses. So it helps us to analyze better, to make decisions better, and to have control on cost better. So that is the objective of this segregation. Now we will see trading account. Trading account always write for the year ended 31st March, suppose 2018. Now, what are the contents and how it is prepared? Again, there are two sides, debit and credit. Never forget to write on the top of the sides debit and credit. Now, manufacturing. From where manufacturing start? Opening stock of raw material. Now, if you observe the particular year, this will not stop. We have just divided the period into one uniform accounting year. So, to know, to take overview, the whole life of the business is divided into equal periods called accounting period, which is in India we follow 1st April to 31st March. On 31st March, the business is not stopped. We have just taken a last date to know what is the profit for the uniform year. So on 1st April, when the year will start, last year closing stock becomes this year opening stock, and you will start with that stock. So it starts with opening stock. Now, after opening stock is finished, you have to purchase the raw material. That is the main component of manufacturing expense. So, next is two purchases. We have also seen the classification of goods account. So, purchase and purchase return, they are related. In final accounts, always two related accounts are taken together so that we can interpret it in a better way. So, two purchases, immediately you will deduct purchase return. Purchases minus purchase return, this figure you will consider. Because you suppose you have purchased goods of 1 lakh but you have returned for 5,000. Exact what are the purchases? 95,000. So you have to consider purchases minus purchase return. After this, all manufacturing expenses. So maybe to carriage inward. Carriage means traveling expenses. So when you are purchasing material, you have to pay for transportation of material. And when goods are coming in, you will call it as carriage inward. So to carriage inward, then all other manufacturing expenses. To factory rent, to all factory expenses, etc. So whatever are other expenses related to manufacturing of goods are debited. Now if you observe, we are following the same golden rules. Debit for real accounts, debit what comes in. So whatever goods are coming in, we have debited. Going out, we will credit. Then all expenses we will debit. Now on credit side, main is sales. Same way as sales and sales return are they are related. So sales minus sales return. that figure will be taken for consideration. Sales minus sales return. Then main thing will be closing stock. Whatever goods are left, they will be called as closing stock. So in mathematics, we have seen the equation sales minus expenses or total expenses is equal to profit. Same we are following, only in accounting the presentation is different. On credit side income, on debit side expenses. Now we will balance the account, that is take total, repeat it on other side. Difference is called to gross profit. Sometimes the expenses are more than sales income. Then the businessman will be suffering losses. Then you will find the balance on this side by gross loss. In final accounts, all are connected. So now we will see profit and loss account. First, we will understand what is profit and loss account and what is the difference in trading and profit and loss account. So, profit and loss account is extension of trading account. In trading account, we have restricted to manufacturing expenses. In profit and loss account, we will take all expenses incurred after manufacturing, administrative expenses, selling expenses, distribution expenses, any other expenses related to business. So when you say business, there are n number of expenses other than manufacturing, all are taken in profit and loss account. Now again this account is balanced and it is called net profit. So gross profit is after manufacturing expenses, net profit is after manufacturing plus administrative, selling, distribution expenses. Now we will see format of profit and loss account. The first item of profit and loss account is gross profit, because gross, if there is gross profit, it will be credited to profit and loss account, and if it is gross loss, it is debited to profit and loss account. So first you will take by gross profit, if it is loss, to gross loss. Starting step of profit and loss account. Then you will go to trial balance. All non-manufacturing items we will take one by one to profit and loss account. So for example, to salary, wages are debited to trading account. Wages means the expenses incurred on labor, that is converting raw material into finished goods. But salary is paid to administrative staff, that is called salary. So you will take to salary, to advertisement, to printing and stationery, to telephone expenses, to depreciation on fixed asset, to interest paid. So this list goes on and on. All expenses incurred other than manufacturing are debited to profit and loss. Then on credit side, you will take all incomes of the business which are not considered in trading account. So by commission, by interest, by dividend received, etc. Same way, you will balance profit and loss account. The side which is more, if credit side is more, then there is profit, means income is more than expense. If debit side is more, then it is loss. So you will take total of credit side, you will repeat it on debit side, and the difference is your profit or loss, to net profit by net loss. So this is called profit and loss account, which gives us the result of profit or loss. Last statement in final account is balance sheet. Now what is the difference in these two? Trading and profit and loss account are the accounts which consider the period of 1st April to 31st March. But balance sheet is a statement which is prepared as on 31st March. It doesn't take the overall of year. So if you see cash balance, it is cash balance as on 31st March. Furniture as on 31st March. Then any liability, creditors as on 31st March. So that is called balance sheet. Balance sheet is the statement showing assets and liabilities of business. So now we will see the format of balance sheet. There is no debit and credit to balance sheet as it is a statement. And there you cannot find out balance because balance sheet has to be tallied. Always remember, balance sheet you have to write as on 31st March. On left hand side we show liabilities, and right hand side we show assets. The balance sheet starts with capital. We have seen in entity concept, capital is the amount invested by owner into the business, and drawings means amount withdrawn. So related term we will take together. This represents owner's account, and then we add net profit or we deduct net loss. This part represents owner's account. So as we are going to see in this particular term, the sole proprietor's account. So whatever profit, as he is the only owner, he will take the profit, or loss, he will incur loss. So net profit or net loss, the final figure is taken here. Now after this, you will take all borrowings. Borrowings of the business, and then you will write all current liabilities. What is the meaning of current liability? Current liability is a short-term liability. The liability which are required to be paid within 1 year is called current liability. So what are the current liabilities? Creditors, bills payable, bank overdraft, outstanding expenses, etc. So left side we have seen of the balance sheet. Now right side are assets. Assets are divided into two. Fixed assets, that is land and building, plant and machinery, furniture, vehicles of the business, and current assets, debtors, bills receivables, inventory, that is stock, bank balance, cash balance. So roughly we have seen the main contents of balance sheet. The balance sheet has to be tallied because from the initial stage we have seen debit is equal to credit. So the balance sheet has to be tallied at the end, and if it does not tally, then you have to find out the error. Now we are going to see the steps to prepare final accounts. Now you will be provided with the trial balance. We have seen trial balance. All ledger accounts are summarized. So there will be debit balance, credit balance. First check that the trial balance should be tallied. Now you will take items one by one from trial balance. So if the item has debit balance, you have to give debit effect. And if the item has credit balance, you have to give credit effect. Where to give the effect? Either in trading account, profit and loss account, or balance sheet. Now, after trial balance, you will find adjustments. Adjustment means the which is not covered in the whole cycle, journal, ledger, trial balance. It is after the trial balance. So adjustments like the closing stock of the business is valued. What is the closing stock value that will be given? So that will be the adjustment. Now, in while preparing final accounts, you have to give two effects of every adjustment: debit and credit. In trial balance, what we have seen? Only one effect: debit balance, debit effect; credit balance, credit effect. So after, you have to either post it to trading account, profit and loss account, or balance sheet. Then after all items are posted from trial balance and effects of adjustments are given debit and credit, what you will do? First you will balance trading account. So you will find which side is more. If the credit side is more, there is profit, you will calculate gross profit. If debit side is more, you will calculate gross loss. You will take it to profit and loss account. Then you will balance the profit and loss account and you will find whether it is net profit or net loss. Then it is taken to balance sheet, and at the end the balance sheet has to be tallied. So all these steps you have to follow to prepare the final accounts of the business, and final accounts will give you the overview of all the business over a financial year. Thank you.